Good morning, everybody, and welcome to this Dafferns webinar brought to you this morning by Dafferns Wealth. And we're looking at business protection, helping you to understand how to limit the risks to your business. Dafferns Wealth are independent financial advisors and providing advice to loads of Dafferns clients, including charities, individuals, and corporates, focusing on investment, protection, and pensions, as well as other services, including mortgages, will writing, and estate planning. Dafferns Wealth Limited is an appointed representative of Insight Financial Associates Limited, which is authorised and regulated by the Financial Conduct Authority. The two speakers that we have with us this morning, firstly, Steve Wheatcroft, who's been the face of Dafferns Independent Financial Advice for getting on for the last 10 years, the last two of which have been through Dafferns Wealth, but Steve's been involved with the firm for a long time now. Steve provides advice to individuals and corporate clients on all aspects of wealth management, pension planning, and individual and corporate protection. With Steve this morning, we have Rachel Legg. Now, Rachel has been an independent financial advisor since 2009, and she specialises in investment and retirement planning, inheritance tax planning, and protection advice, which is the subject of this morning's webinar. So with no further ado, I will hand over to Rachel for the first session. So over to you, Rachel.
Thank you, Martin. So as you know, we're going to talk about business protection today. I think most of us are familiar with the idea of personal protection, and by that I mean life cover, critical illness cover, income protection. But actually not all business owners are aware that there are products available to them as business owners that help to protect against some of these issues from happening within the business. So first of all, we're going to look at the business cycle and the different stages that you might go through, and particularly the different risks that you might face. We're going to look at the four main areas of business protection, and here they are: paying off debts with business loan protection. We're going to look at the value of your key employees, and in that we're going to look at key person insurance. Steve's going to have a look at how you protect the ownership of your business by taking you through share protection. And then we're going to look at relevant life plans and how you can actually protect your family through the business. And then finally, one of the reasons we're here today is to help you find out more, perhaps give you some ideas that perhaps you've not thought of. So what's the structure of your business? Well, there's three main ways that you can set your business up, either as a sole trader, partnership, or a limited company. Now, apparently 62.6% of private sector businesses are actually sole traders. A partnership, well, this is essentially where you're sharing responsibility with another person, with your partner, and you take partnership ownership of the profits as well as the losses. And then lastly, we've got limited companies. And of course, these are the slightly more complicated area, but the business is owned by the shareholders, usually the company directors. And importantly, because the business finances are completely separate from the personal side finances, this would be a very good reason for setting up a business in this way. Now, we know that businesses grow and they evolve. So some of the issues and challenges that you face as a business owner will also change and evolve over time. Now, even with a good business plan in place, things can crop up to throw a spanner in the works. And I think we've all seen that over the last 3 or 4 months. And the main threats to business are those of running into financial difficulties. It can be those unexpected costs, such as adapting to COVID, rent increases, reduced profits. These things can happen at whatever stage of business you're in. And we're going to take you through the main 3 stages that we can look at. You might be a newer business, sort of a startup, and typically that would be a business that's within its first 2 years of trading. And because of that, it's generally going to be a smaller business, and around half of these are actually going to be sole traders. Now, the particular issues that this kind of business is going to face is that, if you're a small business, you're a startup, there's probably going to be 1 or 2 key employees. And so it's more important to think about, what impact will losing your key individuals actually have on your business? What if someone's critically ill or dies? Do you need to have some insurance in place to protect against this risk? The next phase that you will move into as a business is sort of that maturing phase. So probably 3 years up to 10 years, and business is growing. We've got more profits coming in, and we've moved mainly now from being sole traders to mainly being limited companies, with around 2/3 actually being in that category. Now, at this stage, your needs have probably changed. You've probably got bigger business going on. You've got perhaps more people involved, but also you've perhaps taken on some debt to try and expand. So again, what happens at this stage? You face financial difficulties and debts need to be repaid. How do you deal with this? And then finally, we're moving on to that more established business. At this stage, if you've been going for 10 years, you've probably got quite a sizable business. And apologies for anybody who's listening, but you're probably going to have owners who are that more mature stage. So actually the issues that we might be looking at here is, what happens if somebody becomes seriously ill? Have we got succession planning? How do we cover somebody who can no longer work. So essentially, as you move through the business cycle and your need to protect certain aspects of your business will change. Do you need to protect against the loss of a key person? Do you need to make sure that debts could be repaid? Now, what happens if a shareholder dies? And finally, most of us are in business to actually try and make a future for our families. What do you do to protect your loved ones if you're actually to die? So we're going to look at all of these different areas. So the first area we're going to look at is actually the idea of paying off debts that you might have amassed. Now, these debts typically for a business will be things like the bank overdraft. As you move through things, it might be that you've got a commercial loan, commercial mortgage if you've got a property, but also directors' loans as well. When Legal and General did some research, around a third of respondents to their investigations didn't actually realise that a director's loan needed to be repaid. And if you think about this, this is quite important, particularly if you've got more than one director. If one of those directors passes away or dies, the family are going to want that loan to be repaid. So when you're thinking about debts, which businesses are most at risk? I mean, generally it's going to be those startups or those that are growing at the moment, because those are the ones who are going to need to borrow at that stage. Again, some research done by Legal and General tell us that nearly a third of small and medium-sized companies don't actually insure those debts. So how do they repay when the time comes? And with regard to sort of startup businesses, that's even less. The cost of the cover, which will be paid by the business, really is determined by how big is your liability, what amount of debt are you looking to cover, what is the age of the person. The older you are, the more expensive that cover will be, the bigger the liability, the more expensive that. But again, it's just a matter of looking at your individual circumstances, and that's where myself and Steve can help you determine what sort of cover do you need to have in place and how much might that cost. And it could be less than you think. I've talked about the idea of somebody dying, but actually it's also important to acknowledge the fact that actually people can become very ill, and you can also apply critical illness cover in these sorts of circumstances as well. Encourage everybody to think about that. It does increase the cost, but actually the reality is you're more likely to be diagnosed with a specified critical illness than to die during this time. So moving on to the next area, this is where we sort of think about key person protection. What about your employees? You know, if you've got key individuals within your business, what happens to your business if something happens to one of those key individuals? You know, how will your profits or your sales be impacted? If somebody dies or is critically ill, you know, what is actually the cost of replacing that person, finding them, training them up? Who are those key people? It could be the managing director, it could be a finance director. But when you're looking at insuring that key person, you need to consider how long they're going to be key for. It might be that they're not directly contributing to profits. On the other hand, you might find that the business just may not function without them. When we're calculating how much cover you might actually need as this sort of key person protection, this can either be done by taking a multiple of either the key person's salary, and the alternative is, well, actually we look at it as how do we replace the profits that key person was responsible for generating. So those are the two ways that we determine how much cover do you need. Now, again, when asked, you know, how would your business be affected if you lost one of these key individuals to your business? 40% of businesses actually said that they would have to stop trading within a year. In terms of new businesses, 46% would stop trading immediately, would be absolutely devastating. And not surprisingly, 2/3 of sole traders, again, would cease to trade immediately. It's worth thinking about who are the key people in the business and what can you do to prevent the business from being affected by the loss of that person. Right, so how does key person protection actually work? Well, the business, again, pays the premium, and this can be based on life cover, it can be critical illness cover. Now, if that individual then does die or is diagnosed with a specified critical illness, hopefully the policy's proceeds will pay out. That's what it's designed to do. It's going to help the business maintain profits. It will give the business an opportunity to find somebody else, train somebody up, succession planning, all of that sort of stuff, and also potentially to repay any debts. There are potentially tax implications. Now, it might be possible to offset key person insurance against your corporation tax, as it's often treated as an allowable business expense. If you do have a claim that pays out, this is likely to be treated as a trading receipt and therefore will be subject to corporation tax and therefore increase the overall corporation tax bill. For us to sort of define how a key person plan should be set up, though, we need to make sure that any policy is short term. So it again is thinking how important is that key person for, you know, over what period of time. The cover must cover an expected loss of profits. And finally, policy really must be designed for an employee. You can insure a business owner, but actually this could complicate the tax issues, so it's best to be an employee. On the face of it, key person protection sort of sounds a little bit more complicated than the business loan protection, but essentially it's really important to get the advice. And that's again where myself and Steve can come in and guide you through that process to establish how much cover do you need. I'm now going to hand over to Steve, and he's going to look at how you can actually protect the ownership of your business.
I'm going to talk about share protection cover, which is really protecting the business itself in the event of a death. And then I'm going to look at relevant life cover, a particular hobby horse of mine, because it can just save so much money. Start off talking about share protection. Now, I know, because I've been there myself running a small business, if you set up and you run and you manage a small business, you've got all sorts of issues to think about. You're looking for customers, you're looking at marketing, you're keeping records, you're worried about managing your staff. A lot of responsibilities. So it probably means there's a lot of what ifs. And of course, that really big what if is, what happens if you die? What happens if one of your fellow business owners die? Because actually it could mean, as Rachel pointed out earlier, there's a massive impact on your business. It might not even be able to survive. It is so simple and relatively cheap to cover yourself against that. Now, there's a few slides coming up. They've got some jargon on them, but don't get bogged down by that. We'll talk you through it. We provide all the paperwork and set it all up for you. Yes, we'll use trusts. And yes, we'll use something called a share option agreement for share protection. As Rachel said, think about the premiums. In principle, we don't try to claim tax relief on the cost of premiums for share protection cover. And as a rule of thumb, that normally means that in the event of a claim, the proceeds will be tax-free. But what it boils down to is, are you comfortable that in the event of somebody's death, that you can keep the business running, that you've got the funds to support it going forward, and perhaps even more importantly, that your family, if it's you that dies, are going to be protected and will actually recover the value of your share of the business. You may well have given thought to this, and I hope you have. You may well already have a shareholder agreement, a partnership agreement that fully covers what happens if one of you dies. And if you do, that's great. We'll have a look at it, just make sure it's appropriate. If you haven't, it may be that the Articles of Association, Memorandum of Association for the company, does cover it to some extent. But again, let's have a look at it. We want to help you. We will not charge you to come and sit with you and talk about the principles, look at what you've got, look at any arrangements that you've got. It costs nothing to talk. You're trying to protect the owners of the business. You're trying to make sure that if anything happens to them, their families are secure and they don't lose the value of their share of the business. But of course, you're also trying to protect the business itself and put it in the best possible position to survive the death of one of the owners. And of course, that also means protecting the employees, because if your business goes under because you haven't got this covered, it can affect a lot of people. So as a starting point, what is the value of your business? The old adage is that the value of the business is what somebody's prepared to pay for it. And particularly with a small business, that really is the case. But I think it's useful to at least have some idea. And the first port of call is going to be your account. Just ask them to value the business, give you some idea of the amount that you think it's worth and therefore your family deserve if anything happens to you. There are various formulas that they can use to do that. You've probably all heard of price earnings ratio, which is basically the relationship between the share price and the earnings per share. It might just be based upon the asset value, the balance sheet value, but at least if you've got some idea of the value, then we can use that as the basis. There's two basic ways of doing this. It's much simpler than it looks on this screen, and we help you with all the paperwork. But the first option is basically where the company as an entity, the business, sets up the cover and pays for the cover for the shareholders or partners. If it does that, then it's the company paying the premiums, and we set it up on what we call a life of another basis. Yes, the company is paying the premium. As I said earlier, we normally wouldn't try and claim tax relief on that, and on that basis, we would expect the proceeds in the event of a claim to be tax-free. But what we're creating is a pre-agreed formula where everybody accepts that if a shareholder dies, then the company has an option to buy those shares back in, and the personal representatives, the family, also have the option to sell. So everybody knows what would happen, and effectively that enables the company to buy those shares back in. Normally, probably just cancel them. And of course, the effect of that is that the value of the shares held by the other owners is increased proportionately. The other alternative is premiums are paid by the other business owners. Each business owner effectively takes that cover on the others. But it's the same principle. Life cover is in place, and we have an agreement, perhaps a double option agreement, perhaps a flexible business trust that we will supply and talk through, but at least it makes sure that the mechanism is in place to make sure the proceeds are paid out as everybody would want them to be. Again, there's an agreement between all parties. It just means that you know what's going to happen. You're covered. We so often see businesses fail in these circumstances, and it's a shame because it's so easy to avoid. Okay, now I'm going to talk about relevant life cover. Bit of a hobby horse of mine. Most of us will have life cover in place in some form. You might have term assurance in place to cover your mortgage, to make sure your family are protected if you die, to make sure any other liabilities that you've got can be paid off if you die, to make sure your children are protected and that they can enjoy a lifestyle if you're not around to provide it. But there's a much better way of doing this if you're in a position to do so. This is actually quite inefficient. Now, it may well be that you have in the business something called death in service cover, which is a group life policy normally linked to the pension arrangements. It's normally set up as a multiple of salary. So you might see 4 times your salary built into a group policy so that everybody's got some protection in the event of death. But it's got some limitations. It doesn't really work for very small companies because there's not enough people to get group terms. You certainly can't set it up for a single individual. There's no continuation option. So if you leave the business or leave the company, it ceases. And it can actually have some tax implications. It can affect the pension lifetime allowance and annual allowance. But on the positive side, it does at least give some tax benefit to the company because it can claim corporation tax relief. It's not a benefit in kind. There's no P11D or tax implications. In the event of a claim, the benefits are paid tax-free. And group life cover, as the name implies, because it's based on group rates, multiple lives, it tends to work out a bit cheaper. So that's probably a slightly more efficient option of gaining life cover, but the better option, if your circumstances fit, thank you, Martin, is relevant life cover. Relevant life cover, quite simply, is a policy set up by the company, paid for by the company on the life of business owners, senior employees, key individuals. It's much more flexible than group life cover. You can do it on a single life, so it suits small companies where there's not many people involved. It's flexible. You've got much more control over how much cover you want to put in place and for what term. There are continuation options, so if the individual leaves the company, he can normally carry on the cover personally. No tax issues in terms of the pension lifetime allowance or annual allowance, and it's very tax efficient. It actually potentially costs about half of what it would cost you to arrange life cover yourself, and that's why it's a no-brainer. It's something you really should consider. There are some limitations. It's only available to people whose income is subject to pay-as-you-earn, so directors, employees. It only provides lump sum death benefit up to the age of 75. It's only life cover. You can't have, for example, critical illness, and therefore it has no surrender value. It's pure life cover. Stop paying the premiums. It simply ceases. The premiums, as I say, are paid by the employer. No benefit in kind issues. You don't have to worry about paying national insurance to get the net income into your hands, or income tax. The premium will qualify for corporation tax relief. As I said, no effect on the pension annual allowance or lifetime allowance, and the proceeds will be free from inheritance tax. Again, don't be put off by the paperwork. It looks more complicated than it is. Yes, we have to set it up under a trust, but we supply documentation and talk you through that. Because it's set up under trust, the trustees, who are normally the directors, pay out the benefits, but actually as part of the process, we always suggest that the individual covered completes a nomination form so everybody knows exactly what the proceeds to be distributed. But this is the point, it's the numbers. So let's look at an individual who has a life policy, he's set up himself, he's paying it out of net income, and it costs him £1,000 a year. Well, the point is that, let's say he's a director of the company, to get that £1,000 into his hands, the company have had to pay him salary, which has been subject to employee national insurance. In this case, we've used the lowest percentage of 2%, £34. He'll probably pay income tax, but let's say 40%. The employer will also have to pay national insurance, 13.8%. The bottom line is that to put that £1,000 into the hands of the director, it's actually cost the company £1,962. The good news is it will get corporation tax relief on that, as it would with any salary. The real cost is £1,589. If we go down the relevant life route, we can create exactly the same premium, but the company is now paying the premium. So we've no issues with national insurance, we've no issues with income tax, so the cost is simply the £1,000. And even that qualifies for corporation tax relief. So after 19%, the effective cost £810. It's nearly half the real cost of the individual having that cover in place himself. It makes so much sense if you're in this position to relook at any life cover that you've got and set it up on this basis. The first port of call is probably the business owner, the director. You can actually offer it to any key employee or high-earning employee, as an extra benefit. Obviously, it works really well for smaller companies who can't do the group life cover. And it may well be that even if you've got a small a group life scheme offering 4 times salary, there are individuals that you'd want to offer extra cover through relevant life to top that up. Share protection, so important, so easy and relatively cheap to look after your business and protect it. And relevant life, because of the tax breaks that go with it and the way it's set up, is such a cost-effective way of getting life cover in place. And the key to this is we'd like to help you. We'd like to look at any cover you've got in place as your business develops, make sure that it remains appropriate for you, and just generally look at the risk that your business faces and how we can cover it.
Thanks, Steve. Thanks, Rachel. Certainly Relevant Life is something which I've found to be really useful. I swapped over to Relevant Life about 10 years ago, and it does exactly what it says on the tin. I think the premiums were about half, simply because you're paying it out of company profits with corporation tax deduction rather than you as an individual paying it out of after-tax income. So do we have any questions? I think Brian Jukes may have a question for us.
Yes, I do have a question, actually, Martin. Thank you for putting that to me. Steve, the shareholder protection policy, you mentioned that would be written into trust. Can you explain what the benefit of that is for us?
It's really to make sure that it stays outside the tax net. With most types of life insurance, we want the proceeds to be passed through a trust, because that means that they're not caught either as profit for the business or as taxable income for the individual. Technically paid at the discretion of the trustees, but in practice, they would just accept the nomination form and the wishes of the individual.
And Steve, am I right in thinking that that takes it outside of the inheritance tax net as well?
Absolutely, yeah, completely outside the inheritance tax net.
Very good, thank you.
Yeah, I think the principle here is we're here to help. It looks like a fairly complex subject, actually isn't. We can talk you through it. We can produce all the paperwork. It costs nothing to ask the question, and at least let us have a look at the risks that you face and make sure that you're protected.
Brilliant. Okay, well, thank you very much, Steve. Thank you, Rachel, and have a good day. See you soon. Cheers. Bye.